Bismillahirrahmanirrahim. Assalamu alaikum everyone. My name is Yasir Yamin and I welcome you all in this session. Now, while you're preparing for your SBR exam, one question your examiner might ask you. There can be a scenario where your parent company has really invested in another corporate structure, but you have to distinguish if that investment represents a business combination or if it represents an asset acquisition. Now, my fellows, remember, sometimes some particular assets are carried under a corporate structure. So, for example, from Pakistan, if you are trying to invest in a foreign country, sometimes what you do is you transfer a particular asset into another company and then you make investment in that company. So you try to buy the asset through the corporate structure. However, from an accounting point of view, you really need to distinguish if you are investing in a particular asset or if you are investing in a real life business. Remember, fellows, the accounting for either of the two cases is pretty much different. If you're investing in a business, it's a business combination to be accounted for under IFRS 3. If it's accounted for under IFRS 3, then you have to follow the consolidation process. However, if it is an asset acquisition, it will only be accounted for under the relevant accounting standard. All right? So how do you know? How will you get to know in an examination question if it's really a business combination, yes or no? Now, for that to happen, you need to take a deep dive into the understandings of IFRS 3. Now, IFRS 3 defines what is a business. We will go towards the definition, but just carefully think about it. How would you define a business? You see, in a normal business setup, you see that there is workforce available, there are inventories, there are processes, there is manufacturing, there are service departments, there are processes that have the ability to create output. So in very layman terms, you see a business as an integrated set of activities, as an integrated organizational setup in which there are multiple processes that ultimately help you to create a particular economic benefit. Yeah. So if you have your layman knowledge, your layman understanding in your mind, you can easily refer to what IFRS 3 says about it. Now, IFRS 3 defines a business. Remember, if an investment is classified as an investment in a business, then only IFRS 3 applies, business combination applies, and you follow the consolidation process. Now, IFRS 3 says that a business consists of inputs and processes applied to those inputs, and that have the ability to create outputs. Common sense. Now, generally, a business is something which has inputs, so it takes from the environment, it takes from others. That has the ability that when processes applied to those inputs, so you create the manufacturing process or the service process, you create the trading process, you form a process, and through that process you try to create an output. An output is something which actually has the ability to provide you some sort of economic benefit. Now, IFRS 3 does say that although businesses usually have outputs, every sort of business has an output. I'm delivering an output to you. Now, a banking company creates an output by selling you their banking services. A manufacturing company produces output by producing the goods that are to be sold into the market. Yeah, although businesses usually have outputs are not required for an integrated set of activities to qualify as a business. Now remember, this particular area that I highlight to you, this particular area is a precaution for you. Remember, IFRS 3 says in its first line that a business is identified as something which has three main characteristics. It must have inputs, it should have processes that when applied to those inputs create outputs. However, in certain setups, output may not be available. For example, just consider a research company, research laboratory, which is not yet able to create an output because they are still searching out on the resolution of a particular virus, on how to treat a virus. Now, there can be multiple examples like that. Just consider a company which is trying to mine cryptocurrency. It has not yet been able to create an output, but it is following the lengthy process of mining to create a particular digital currency or a non-fungible token, for that example, NFTs. So a business is still a business if it has input and it is applying the relevant processes and they are trying to create an output. Even if output is not yet available, it still can qualify as a business. Now guys, as I just said, IFRS 3, if you break down this definition, IFRS 3 defines a business as some organizational setup which has three proper characteristics. As I said, it must have input, it must have processes, and then it must have outputs. Now, output is optional in certain circumstances, but yes, output is one of the qualitative characteristics. Now, sir, what do you exactly mean by inputs? Because when we are going in our exam, we need to have some content to write into our examination. Now, inputs mean any economic resource that creates or has the ability to create outputs when one or more processes are applied to it. Now, inputs does not necessarily mean raw material. Inputs does not necessarily mean inputs as in inventories, but rather input is anything which has the ability, when processes are applied to those inputs, they have the ability to create outputs. Yeah, so it is something used in processes with the concept in mind that ultimate vision is to create an output. Now, common examples of input can be that there are non-current assets available in that corporate structure, be it intangible assets or right to use leases or intellectual property, any input which when processes are applied upon, they will create output or they have the ability to create output. Now, while you are going in your exam, you just try to find out in the scenario if there are inputs available, if there are certain assets available, if there is raw material available, if there are intangible assets available, if there are relevant licenses available. All of these create an input for the business. Now, after inputs, one of the most important characteristic that you have to identify in your scenario is basically processes. A business, in order to classify any corporate structure as a business, it must have processes. Now, by processes, IFRS 3 means it must have a system, a standard, a protocol, or a convention or a rule that when applied to an input or inputs creates or has the ability to create outputs. I mean, there must be a strategic management process or an operational process or a resource management process or a production process. It should seem as if, certain set of activities are being applied to inputs that create output, All right. So always remember, whenever you are trying to figure out in an examination scenario, if a particular corporate setup, if a particular company setup can be classified as a business, then just search out for these two particular items, input and processes. Last but not the least, outputs. Remember fellows, as I just said, outputs are not mandatory. If there can be a business which have inputs, which have processes, and they are trying to create outputs even though they are not successful yet, That's fine. However, outputs are defined as the results of inputs and processes. As simple as that. You need to just learn this. The results of inputs and processes. The output can be in the form of the ultimate output from an investor's point of view. It can be something that you create that will provide dividends to shareholders, or maybe lower compensate your investor in terms of economic benefits, your members, your participants. It creates an output. Output is something which has the ability, which has the characteristic to provide benefit to the ultimate shareholder. Yeah, so anything which will ultimately benefit the shareholder, the investor, the members, the participants, that is an output. All right. Now, you do understand that whenever you're looking at a scenario, you will always try to find out and clarify to the examiner that there are inputs available or there are not available, there are processes available or they are not available, and you will try to figure out if outputs are there, yes or no. But a question comes into your mind that, sir, what happens if we classify an acquisition as a business combination? Or what happens if we don't classify it as a business combination? Now, in my coming slide, I am going to put in front of you the clarification of what happens in which scenario. You see, if you conclude that although it was a corporate structure, but eventually you have acquired an asset. I'll give you an example. Now, this is a very common example locally, but many of the local people would understand that what I'm trying to say, but still, my other fellows just try to, understand the concept that I'm going to deliver. Imagine that, there is a company whose name is PLN, all right, and this is a company in Pakistan, all right. Now, let us suppose PLN has made an investment in another company, which, for example, is in a foreign country. We can call it like it is in Panama. So just imagine there is a Pakistani company, PLN, and it has invested, few $1 million in another company, which is in another country, Panama. And this company has really got only one asset, which is a building. It has got only one asset, which is a building. Now here, the accountant needs to make an, assessment. The accountant needs to make an assessment if this acquisition really represents an acquisition of a company with proper set of integrated activities that actually results in a business. Or rather, if you see that PLN has, although through the corporatization process, but it has really invested in a building. Now, if you have really invested in a building, the ultimate beneficiary, the ultimate benefiting point is the building. You need to classify this as an acquisition of an asset. Or in another case, if you have really made an investment in a company, then it will be classified as a business combination. Now, if the accountant comes to the conclusion that although we acquired shares in a company, but that company only had one asset, so ultimately, substance over form, you have really made an investment in one asset or a group of certain asset. If you have really concluded that you have made an investment in an asset, what will be the accounting consequences? It will not give rise to goodwill. There will be no goodwill accounting because this is not a business combination. You are outside the scope of IFRS 3. You are outside the scope of IFRS 3. Then, the assets acquired are initially measured at cost. So, you will be measuring your investment at cost, or the fair value of consideration given up if it is an exchange transaction. So for example, if it is an asset exchange transaction, you will value your investment based on the fair value of the item that has been given up, Yeah. It will not give rise to deferred tax. Remember fellows, you did discuss it with me that it will not give rise to a deferred tax liability. Initial recognition of assets or liabilities does not create a deferred tax consequence. Yeah. And any directly attributable transaction cost will be capitalized as part of cost of asset. So if you conclude that you have made an investment in a building, most likely you will go for IAS 40 or IAS 16 and you will follow these due processes. Yeah. So this is very important content when you are trying to explain your examiner that what happens in which scenario. You can learn this out. Just learn this out. Okay. Now on the converse, it can be a business combination. For example, you come to the conclusion that although the company currently has only one building, but this building is going to be used as a sales office for products that we manufacture in Pakistan. We are in the hiring process, so we already have a CEO, we already have a CFO, we already have 5 employees. We have not yet created an output, but yes, we are trying to create an output by concluding, by acquiring customers, by creating awareness in Panama about the products of Pakistan, and yes, we are trying to make an output. So if you conclude that if this is a business combination, then remember IFRS 3 will be applicable. If IFRS 3 will be applicable, this will give rise to goodwill. So you will need to calculate goodwill according to whatever proportionate or full goodwill method you like or your company has a policy of. Remember, assets acquired and liabilities assumed will initially be measured at fair values, not cost. Fair values based on market participants' perspective as per IFRS 30. Yeah. Then this will give rise to deferred tax on the initial recognition of assets and liabilities due to fair value uplifts. And then any transaction costs will be expensed out to profit or loss as per the requirements of IFRS 3. So remember fellows that whatever conclusion you reach, it is going to have an accounting consequence. So you need to make sure that you make the right decision and follow the right consequences. Now, I certainly believe that while you're going for your SBR exam, most likely your examiner is not going to ask you for conclusions in a particular scenario. Rather, your examiner would want you to first define what is a business, what is the definition of business, what are the key traits required in an investment to be classified as a business, and what happens in what scenario. So, for example, if a discuss requirements comes into your examination, you will also try to gel in the consequences of treating this transaction in different manners. This is the requirement. Yeah. Now, having understood all of this, I would want you to not be so conclusive at this moment in time, because there is one more thing that you need to understand. Now, this definition of business has been around since a while now. Everyone knows what is the definition of business and how to really identify a business combination. This has been available since a long time. But a recent development that IFRS 3 has introduced is basically known as optional concentration test. Optional concentration test. Now, I classify optional concentration test as a shortcut to identify if it's a business combination. Now, you might have heard many a times about there is something known as optional concentration test. And now, what is optional concentration test? You see, optional concentration test refers to a shortcut test where rather than assessing if it's the input is available or the processes are available, the outputs are available, each accountant applying its own judgment and its own assessment, there is a shortcut assessment available in IFRS 3 nowadays, which is known as optional concentration test. optional concentration test. It is a shortcut to identify if it's a business combination, yes or no. Now, optional concentration test is, you need to assess, whenever you are making an investment, the accountant needs to assess if substantially all of the fair value is in one asset or similar asset. So what are you trying to say? So for example, when the accountant gets a scenario, you see that there is a P company which has invested in another company which can be known as ABC company. Rather than putting in so much efforts, you can simply assess if it's a business combination, yes or no. You just try to assess that what the fair value of ABC company comprises of. So for example, there comes a scenario where ABC company has only one asset or maybe 2 or 3 assets which are of the same nature, and the fair value of the asset is equal to fair value of the company. So optional concentration test is that whenever you see that the investment value of the company, the fair value of the company is concentrated into one or similar type of 2, 3, 4, 5 assets, if you see that all the investment that you have made in the company, it represents or it concentrates up to 1, 2 or 3 assets, then it is pretty much clear that whatever investment you have made is concentrated into 1 or 2 assets, then it should be treated as an asset acquisition. It should be treated as an asset acquisition. In simple terms, if the fair value of your investment is equal to the fair value of the company, which is equal to the fair value of the asset which is available in the company, if your investment value equals the value of the asset, the only asset which is available in the company, then it is quite clear that this is an asset acquisition. You don't need to assess if there are inputs, processes, outputs. You don't need to make any investment. If your investment is concentrated into 1 or 2 assets, if your investment's value is concentrated in the value of 1 or 2 assets, then it is pretty clear that this is the scenario of asset acquisition. This is the scenario of asset acquisition. If you feel that no, we have made an investment in a company and the investment value is not concentrated into 1 or 2 assets, rather there are many people working in this company, there are many outputs being created out of this company, there is many raw material and everything which is available in the company, then then your optional concentration test is failed, and then you need to perform the actual input process output assessment. Yeah, so I'll again say it. The method clarified under IFRS 3 nowadays is that whenever you make an investment in a company, the accountant should first assess if the investment's value is concentrated into 1 or 2 assets. If your investment's value is concentrated into 1 or 2 assets, then okay, this is an asset acquisition. You don't need to perform any further assessment. However, if the test fails or the concentration test is bypassed, then you need to make an assessment. First you assess if there are outputs available, yes or no. If there are no outputs available, then the business should have the processes and the inputs that has the ability to create outputs. Or if the business has outputs, then you need to assess if there are inputs, processes and outputs available. 3 of them should be available. After making these investments, then you will only conclude this is a business combination. Yeah. So optional concentration test, again I would say, is just a shortcut to assess if your investment's entire value is concentrated into 1 or 2 assets. Then simply it is a it is an asset acquisition, it will not be a business combination. Now this flow chart is beautifully designed by PwC. I would like to refer them here. This is beautifully designed by PwC. I would want you to focus till here. From an examinations point of view, just focus on the top area which clarifies that when you apply optional concentration test and what it means. Yeah. Now, having understood this, we will go and look at, one or two questions that, these type of questions you can expect in your examinations. So let us just see this. Now, these are from the PwC guide. So certainly, these are pretty much relevant from your examinations point of view as well. At the end of the day, your examiner will be making an examination question out of what examples have been given in the IFRS book or given by such reputed firms such as PwC. Now, there is example number 1. Let us see. Property company purchases a portfolio of 10 residential homes. Now, my friends, don't get carried away. Although these are 10 residential homes, but you can call them a society maybe, an apartment maybe. So don't get carried away with 10 residential homes. It is an investment in one or similar type of multiple assets. Yeah. So property company purchases a portfolio of 10 residential homes as well as a commercial park containing 6 fully leased office buildings and a fully tenanted retail mall. So your company, the property company, has basically made an investment in another company which has various residential homes. There is a commercial parkway and there are fully rented malls. Yeah. The residential homes and the commercial park are located in the same geographical area. So it is basically a society that is available under a corporate structure and you have made an investment in that corporate structure. It says no employees, there are no employees or any other assets or any other activities available in this setup. What would you say? What would you say? First, you apply the optional, concentration test. Now, don't you feel the entire investment is concentrated in one or group of assets that represents the entire value of the business? Don't you think? Further, it is clear that there are no employees, there is no workforce, there are no processes available yet. So, what do you think? What do you think? In my opinion, this should be classified as an asset acquisition because your investment is concentrated into one or group of assets and there are no processes, there are no workforce available that will create output, that will sell these residential homes, that will sell this commercial park. There are no processes yet available and hence this should be classified as an asset acquisition. And I can even write down this for you. Applying the optional concentration test, it is evident that the entire investment is concentrated into one or group of assets. Further, there is no workforce or processes that will eventually create output such as sale of these residential homes, etc. Therefore, it should be classified as an asset acquisition. It should be classified as an asset acquisition. Yeah. Moving on. So example number 1 was very clear. There were no processes. Optional concentration test also clarified that the whole investment was to be concentrated into one or similar type of group of assets. Yeah. By the way, when you have already applied optional concentration test, technically you don't need to, further assess of, you don't need to make a further assessment of input processes and outputs. Yeah. This is what the PwC flowchart said. Yeah. But still, since I'm just trying to explain it to you from an examination point of view, I made a further assessment and clarified and proved it from another point of view that still, since there are no inputs, there is no workforce available, there is no office setup available, there are no processes available that will eventually create outputs. And there also you can say that this is an asset acquisition, not a business combination. Now let us look at another example, please. It says that property company acquires a commercial park. So this is an example of the same sort as we just saw in example number 1. Property company acquires a commercial park comprising 6 office buildings and a retail mall that is still under construction. So if the mall is still under construction, there will be no outputs yet. Yeah, so you will not be generating any economic benefit as of yet. So you cannot provide any economic benefit to your shareholders, your members or participants. So there is no profitability yet, but still outputs were never mandatorily required. Yeah. So it says that property company acquires a commercial park comprising 6 office buildings and a retail mall that is still under construction, together with the workforce, which includes key personnel responsible for the design, engineering, construction of the commercial park, the sales and the marketing division responsible for the sale, leasing of the office buildings and the retail mall. Marketing of the office buildings and the retail mall is ongoing even before the commercial park is completed. Now for sure you need to bypass the optional concentration test. It is pretty much clear that it is a running business. It is a running integrated set of activities. You don't need to apply optional concentration test here because there are employees working in it. So whatever investment you have made in this company, you would also need to pay for the employees. There is a proper setup available. There is an engineering department, construction department, design department, sales department, leasing department. Sales have been going on for a while now. So there is an integrated set of activity available. Certainly whatever investment you make in this type of a company is not going to be concentrated onto a particular asset, because there are real life human beings available. There are real life going concern set of activities available. So you don't need to apply the optional concentration test. And then you need to assess if there are inputs, processes and outputs. Certainly I would say there is input available. So you are in the process of construction. Yeah. You have your key management personnel. Yeah. You have your sales people. You have the relevant infrastructure where from where your sales people will be working on. They'll be making calls to potential customers, potential clients, and those who would be willing to make an investment in this housing society. So certainly there are inputs available. Certainly there are processes available. For example, there is a sales office which is trying to market even before the construction is complete. Yeah. And further, there is, construction department available, and, design department available, engineering department available. So certainly there are, there is process involved. I agree that there is no output yet, but still on the basis of inputs and processes, you can conclude that this is a business combination. This is a business combination. All right. Yeah. So this was all from my side. You always know where to contact me. Fellows, you always know where to contact me. I'm available for any questions before your exam. Yeah. So you just try and connect with me. Inshallah, we'll see you. Best of luck.